Do you enter a trade and automatically you get stopped out? Or do you enter a trade and the market goes straight against you and you're losing money? Well, it may be because you're entering the trade too late. And on this video, I want to show you where not to get into trades because you're likely to be stopped out. Before I do dive into that training, guys, please make sure you subscribe to the channel, hit that button, hit the bell as well to get those notifications, and I'll look forward to growing the channel with you here at Trading College. Okay, so look, I've put on my momentum indicator down below underneath the price action of this 4-hour time frame of the euro yen, and you're going to have a momentum indicator that you're going to be using, and it's likely to show you overbought and oversold areas. And I hear often when good old-fashioned technical analysts talk about a market can stay overbought for a long time, and I agree on that, but the markets that are overbought most of the time will have some sort of reversal. And if you're buying in an overbought scenario, the likelihood is that you're just going to reverse and stop you out. So use your momentum indicator, give you the heads up of overbought and oversold. And if you feel like this is wrong, then tally up how many winning trades you're having out of losing trades. And see how you get on with the ratio on that and the percentage of winners versus losers. Because if I'm buying the market, I would never buy the market on an overbought scenario like this, where the histograms have spiked higher on my indicator and they're really high. So that represents this price right up here, guys. So the average day trading stop for a retail trader is probably around 12 to 15 pips if you're day trading off a 5-60 minute time frame. But let's give the benefit of doubt here on the 4-hour. It might be 20 points. You're still stopped out. Highs, 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 medium, medium, medium. Okay, so let's look at this. This one right here, this one here, we can see that the histograms are very high up compared to the previous ones, and that represents this area right here. Somebody is buying that market right at the highs because it's trading there, and then the market drops what, nearly 200 pips. There's no way on this earth I would buy that market right there. There's no way I would buy that market right here on the left hand side. I would never buy it because I know that there's an opportunity, or the probability state that the price is going to reverse. So if I'm buying it here and my stop placement's here, I'm out the game. I'm stopped out. You're better off buying the pullback, the reversion back to the mean. You're better off buying it as it pulls back within the uptrend. Remember, uptrends are up, down, up, down, up, down, up, down, and probably an Elliott wave reversal. Okay, so the odds are that the price is going to go higher here. If I buy the top of the market, okay, and even if it goes another 50 points higher, I'm just not interested in buying that. It's not good value for me. So I don't want to be stopped. I don't want to be stopped out of a trade. But I want to get a really good entry, and it's not good value. You could use Fibonacci on the pullbacks, but your momentum indicator has to have an overbought situation, a signal, and refrain from buying it because you're likely to be stopped out on the pullbacks. All right, so bear that in mind, guys. You want to be on the start of the move. You want to define an up move, or you want to be in the start of an up move. You don't need to be in the start of it, but you can be in the middle proportion of it. Up it goes, pulls back. You're looking for the reversal. We call it the bend at the end. Okay, you get the bend at the end. And then as it progresses through the breakout area here, you don't really want to buy there unless it's a wave 4 in an Elliott wave, and that's another subject. But as it breaks that recent high, then you get all the breakout traders that come in and fuel the move higher. Okay, but then there comes a point where it gets overbought, this momentum indicator, and people chase it right at the highs. My entry is here. Our entry is here on the turn, selling to people up here, emotionally buying the trade. Look, I don't want you to get stopped out. I don't want you to lose money. I want you to make money. So maybe think about where you're getting into trades. Use the anchor chart. Use your bigger time frame, like You know, if you're doing a 5-minute entries, maybe use a 60 or 4-hour time frame as well alongside a daily, just to see which ones are overbought, because the price reverts back to the mean, and it's likely to happen. Okay, so just have a look at your stats and just see what you would do if you bought the pullback. If you bought the pullback and the bend as it turned into a new buy signal, and then sold to people much higher who was fueling the move higher. All right. And the people that buy the highs will be right sometimes, but I bet their win rate is like 30% of the time, because they're getting stopped out on that reversion back to the mean. And let me tell you something, nobody will tell you this, that it feels the most uncomfortable buying the pullback. Okay, this is what my mentor taught me 20 odd years ago. Nice move up, comes back down, and as it's coming down and turning, it feels uncomfortable to buy it. It is the best time to buy it because the risk reward is fantastic. Buying the highs, buying the top of momentum feels easy. It's the worst time to buy it, guys. All right, hope it helps. Don't forget to subscribe to the channel, and I'll speak to you on the next lesson.